Welcome back to our stock market education series. In the last episode, we explored short selling and margin trading, two high-risk, high-reward strategies. Today, we are diving into a different but equally important topic: market psychology and behavioral finance. Understanding how emotions and cognitive biases influence investment decisions is key to becoming a successful trader or investor. Let's get started. The stock market is driven not just by numbers and financial data but also by human psychology. Fear, greed, overconfidence, and herd mentality all play a significant role in how investors behave, often leading to irrational market movements. This is where behavioral finance comes in. Market psychology refers to the overall sentiment of investors at any given time, helping explain why markets experience cycles of booms and crashes, often defying logic. Behavioral finance, on the other hand, studies how psychological biases affect financial decision-making. These biases can cause investors to make irrational choices, which often lead to poor investment performance. Fear and greed are among the biggest influences on stock prices, driving extreme market movements and shaping investment cycles. Greed fuels market bubbles, as investors irrationally push prices higher, believing they will continue to rise indefinitely. The dot-com bubble of the late 1990s and the cryptocurrency boom of 2021 are prime examples of how unchecked greed can inflate asset values beyond reasonable levels. On the other hand, fear leads to panic selling, where investors rush to offload assets at a loss in an attempt to minimize damage. The 2008 financial crisis and the COVID-19 market crash in 2020 showcased how fear can spread rapidly, leading to sharp declines in stock prices. Successful investors learn to control their emotions, making informed decisions rather than reacting impulsively to short-term market fluctuations. Cognitive biases often lead investors to make irrational choices, resulting in avoidable losses. Confirmation bias is a common trap where investors seek out information that supports their existing beliefs while ignoring evidence that contradicts them. This tendency can create overconfidence in poor investment choices, making it difficult to recognize mistakes. Herd mentality is another powerful force, where investors buy assets simply because others are buying, rather than analyzing their intrinsic value. This behavior contributes to the formation of market bubbles, which inevitably burst when the trend reverses. Loss aversion further complicates decision-making, as investors tend to feel the pain of losses more intensely than the pleasure of gains. As a result, they may hold on to losing stocks for too long, hoping for a recovery instead of cutting their losses early. Overconfidence bias leads many traders, especially inexperienced ones, to overestimate their ability to predict market movements, often causing them to take excessive risks. Similarly, recency bias makes investors focus too much on recent events rather than considering long-term trends, which can lead to buying stocks at peak prices or selling at the lowest point during the crash. Recognizing these biases is the first step toward making more rational investment decisions. The stock market moves in cycles that reflect the emotions of investors, and understanding these cycles can lead to better decision-making. In the early stages of a bull market, optimism and euphoria drive prices higher as investors feel unstoppable, leading to the formation of bubbles. When growth slows, anxiety and denial set in, but many investors ignore warning signs and continue believing prices will keep rising. As the market begins to decline, fear and panic take over, causing a rapid sell-off as investors try to avoid further losses. This is usually the worst time to sell, yet many investors do so in response to their emotions. When despair and capitulation set in, investors who have lost hope start selling at rock-bottom prices, often missing out on the eventual recovery. Meanwhile, experienced investors recognize the opportunity and begin buying again, leading to a gradual market rebound. By understanding these market cycles, investors can avoid buying at the top and selling at the bottom, positioning themselves for long-term success. Avoiding emotional decision-making is essential for long-term investing success. The best way to do this is by having a clear investment plan that defines risk tolerance, time horizon, and overall strategy in advance. This helps investors stick to a rational framework rather than reacting emotionally to market fluctuations. One effective strategy is to use stop-loss orders, which automatically sell stocks if their prices drop beyond a predetermined percentage. This prevents excessive losses and removes the emotional burden of deciding when to sell. Thinking long-term is also crucial, as short-term market movements are unpredictable, whereas long-term trends tend to reward patient investors. Diversifying a portfolio across different assets helps minimize emotional reactions to the performance of any single stock. Lastly, avoiding the habit of checking the market constantly can reduce stress and impulsive trading decisions, leading to more disciplined investing behavior. Market psychology and behavioral finance explain why investors often act irrationally, allowing emotions to influence their decisions. Fear and greed drive market movements, leading to cycles of bubbles and crashes. Cognitive biases such as confirmation bias, herd mentality, and loss aversion frequently lead to poor investment decisions. Recognizing market cycles can help investors make more informed choices, avoiding common pitfalls such as buying at the peak and selling at the bottom. The key to successful investing lies in controlling emotions, sticking to a well-thought-out strategy, and maintaining a long-term perspective. Those who manage to do so are more likely to achieve consistent investment growth while avoiding costly mistakes. In the next video, we will explore the future of investing, discussing how AI, ETFs, and robo-advisors are shaping the financial markets. If you found this video helpful, don't forget to like, subscribe, and hit the notification bell so you never miss an update. Now, we'd love to hear from you. Have you ever made an emotional investing decision? What was the outcome? Share your experience in the comments below, and let's discuss. Thanks for watching, and we'll see you in the next video.